morning, and thank you. It's an honor to be with you this morning, and let me begin by conveying my best wishes of President Trump. He understands that national strength comes from the ground up, not the top down, and this concept applies to good government just as much as it does to banking and capital formation. For too long, financial policy has served large financial institutions at the expense of smaller ones. No more. No more. This administration aims to give all banks the chance to succeed, whether it's JP Morgan or your local mortgage and loan. It aims to get capital to Americans who need it by getting bureaucracy out of the way. For the last 4 decades, basically since I began my career in Wall Street has grown wealthier than ever before, and it can continue to grow and do well. But for the next 4 years, the Trump agenda is focused on Main Street. It's Main Street's turn. It's Main Street's turn to hire workers. It's Main Street's turn to drive investment. And it's Main Street's turn to restore the American dream. And who's going to lead this revival? The men and women in this room. As community and small bankers, you know the needs of small-town America and your communities better than anyone. You know the concerns of a young couple saving for their first home, the worried look of a single mother just scraping by, and the stress of a father trying to pay for his child's education. You know these people personally. You know how to best help them, and you know it far better than any regulator here in Washington. This is the animating belief behind the Trump administration's approach to small banking policy. Bureaucratic hubris has escaped the Beltway. Our goal is to put it back in its cage. Community bankers can make America great again if the government will let you. My job is to make sure it lets you. This morning, I want to talk about how. In the past, bank regulators have exercised vast powers on almost every aspect of daily life, but without meaningful accountability to the American people. Most glaringly, regulation through supervision has too often taken place behind a veil of secrecy that precludes scrutiny by the public and their elected officials. President Trump is correcting this. He has tasked the Treasury Department with ensuring that the financial services regulators fulfill their statutory mandates consistent with his priorities. To this end, the Treasury Department intends to play a greater role in financial regulation. The Financial Stability Oversight Council, FSOC, is one potential forum. The President's Working Group on Financial Markets is another option. We also regularly engage with each federal regulator. Our guiding principles are rooted in President Trump's focus on restoring common sense to government. First, regulation should derive from a clear statutory mandate. That includes safety, soundness, mitigating risk to financial stability, and consumer protection. Second, regulation should be efficient. This means regulation should strike an appropriate balance between cost and benefit. Third, regulation should be fair. That means the rules of the road should be clearly stated and consistently applied across entities and across time. Lastly, the regulators themselves should be efficient. Fulfilling their statutory mandates does not require ever-increasing budgets and employee headcount. These common sense principles have important practical implications. For example, striking a balance between cost and benefits requires tailoring regulatory actions to the specific risk profiles of different business models. In assessing the cost of a regulatory action, we should be attentive to the potential burdens arising from unintended consequences. In assessing the benefits of a regulatory action, we should remember the tremendous economic and human cost of a financial crisis. As we apply these principles, a particular focus of mine will be the effects on Main Street. In the past, some regulatory actions have unduly burdened community banks or erected barriers to entry. Other regulatory actions have entrenched the dominant positions of the largest banks. More generally, bank regulation has not taken effects on economic growth into account. That in turn has meant less lending, slower wage growth, more inflation, and fewer opportunities for American families. To ensure that Main Street matters more in bank regulation, I and the rest of the Treasury team will devote the necessary time and attention to the quite technical, substantive aspects of regulatory reform. In that spirit, I would like to preview my thinking on a few specific issues. I will start with community banks. Community banks help ensure that the benefits of economic growth reach all Americans across this large and diverse country. They make many of our small business and agricultural loans, especially in small towns and rural areas. They are also the center of their community's civic life, cutting the check for the new playground, teaching financial literacy in schools, and employing many of the local leaders. Our nation's community banks, however, face many challenges, including from existing new competitors, rising costs for compliance, technology, and personnel. In particular, I am concerned that community banks' vital work is undermined by undue compliance burdens. The cost of investments in technology to comply with new reporting and other requirements, the difficulty, time, and expense of recruiting specialists for compliance roles, the expense of third-party loan file reviews at the suggestion of examiners, the lending foregone to avoid undue supervisory scrutiny of relationship banking, and so on. This all adds up. The cumulative effect is a significant drain on the resources, time, and attention of management away from serving customers. For community banks, even a single new compliance staff member is a significant increase in expenses. Applying our common sense principles here, the Treasury Department intends to drive more tailored regulation to the community bank model. There may be strong cases for categorical exemptions of community banks from some entire regulations. In particular, we will be taking a close look at the CFPB's recent rules and the bank regulators' expectations related to internal controls. This will include, for example, third-party risk management and information security. Besides better tailoring of regulation, perhaps the single most important reform will be to refocus bank supervision on material financial risk. Regulators should keep the main thing the main thing. Supervision has an important role in ensuring bank safety and soundness. But as we saw with the bank failures in spring 2023, unduly centering supervision on management, other governance matters can distract examiners and banks' risk managers from the real risks to safety and soundness. The associated mission drift can lend itself to political ends, as we saw with the focus on climate and the debanking of disfavored individuals and industries. All of this drives up distractions and compliance costs while impeding responsible lending and risk-taking. To make matters worse, the banks have no meaningful recourse. Concern about retaliation makes the existing supervisory appeals options more theoretical than real. Regulators even limit banks' ability to share the specifics of their concerns with policymakers, including me, Treasury Secretary of the United States of America, by prohibiting disclosures of confidential supervisory information. The Treasury Department intends to drive a change in the culture of supervision through improvements to examination procedures, enhanced monitoring of examiners' compliance with these procedures, and more realistic processes for appealing supervisory findings. Perhaps the most consequential step would be to define unsafe and unsound by rule using more objective measures rooted in financial risk. In the meantime, I have previously asked each of the bank regulators to consider removing reputational risk as a basis for supervisory criticism, and that effort is well underway. When considering the effects of bank regulation on community banks, we should ask ourselves, why so much financial activity has moved out of the regulated banking system? For example, the shift of mortgage lending to non-banks has undercut an important line of business for community banks. It is clear this shift out of the banking system is to some degree driven by regulation, in particular by outdated capital requirements on some exposures that are well in excess of the latest evidence on the actual risk of those exposures. Modernizing regulatory capital could reduce risk to financial stability by leveling the playing field across banks and non-banks. Modernization also could enhance banks' ability to support innovation and economic growth and improve their safety and soundness. Modernization was purportedly even the original intent of the Basel Committee's endgame standards. However, the July 2023 proposal under the Biden administration to implement these endgame standards is not, in my opinion, the right starting point for our modernization effort. Important aspects of the endgame standards cannot be explained or even understood because the Basel Committee offered little rationale. Despite that, somehow, the only time the U.S. bank regulators found cause to deviate from the Basel Committee's standards was to reverse engineer increases in capital. We intend to take a different approach. We should not outsource decision-making for the United States of America to international bodies. Instead, we should conduct our own analysis from the ground up to determine a regulatory framework that is in the interest of the United States and its citizens. To the extent that the endgame standards can provide inspiration, we could borrow selectively from them, but this should only be done to the extent that we can independently validate the underlying rationale and then make that rationale available for public comment. A significant open question would be how to foster competitive parity across large and small banks and non-bank lenders. Modernizing regulatory capital likely would mean reduced capital requirements for mortgage loans and some other exposures that are core to the community bank model. Giving only large banks the benefit of the reduced requirements for those exposures, as actually contemplating under the Biden administration, would have entrenched their already dominant position. One possible solution would be to give each bank that is not mandatorily subject to the modernized requirements the option, in its discretion, to opt in. This is what I mean by ensuring Main Street matters more. While we're on capital, I should briefly acknowledge that we will also look at the capital buffer framework that applies to the largest banks. The process for sizing each large bank's stress capital buffer, for example, should be consistent with the law and otherwise provide appropriate transparency and opportunity for comment. That is especially important here, given the role that the associated stress testing indirectly plays in the pricing and allocation of financing. I have previously raised concerns about whether the leverage capital restrictions are too frequently binding. The bank regulators are now hard at work to develop a proposal to ensure that leverage capital functions as an appropriate backstop. The post-2008 reforms required large increases in banks' investments in central bank reserves, treasuries, and other high-quality assets that can be liquidated during a stress event. More than 1/4 of banks' balance sheets now allocated to these assets, more than double the share before the 2008 crisis. While strengthening liquidity, The shift to safe assets has meant less funding available for loans and other productive assets. Some of that shift was driven by the increase in reserves created by the Federal Reserve's quantitative easing. Abundant reserves might have prompted some examiners to ratchet up their expectations as to minimum reserves without any formal change in regulation, essentially establishing a de facto reserve requirement through supervision. It is time that we step back and reassess these and other cost benefits of the liquidity framework. This assessment should identify opportunities to expand the role of loans and other productive assets as collateral for funding during a period of stress, and thereby help get banks back into the business of lending. For example, we will revisit the role of the discount window and the federal home loan banks, including whether there are opportunities to clarify the role of these funding sources in internal liquidity stress testing and the supervision of banks' contingency funding plans. Our assessment will also consider whether examiners have developed a bias toward reserves over other liquidity sources and how we can better ensure that liquidity buffers are indeed buffers, not regulatory minimums, that banks can draw down during a period of stress. This is only the beginning. The Treasury Department plans to revisit the other aspects of prudential regulation. We will advocate for changes to the AML-CFT framework to truly focus on national security priorities and higher risk areas and explicitly permit financial institutions to deprioritize lower risk. We will work with Congress to consider reforms to deposit insurance, including potentially higher limits for business payment accounts. We will consider enhancements to failed bank resolutions to incorporate the lessons learned from the bank failures of 2023, including efforts to reduce the FDIC's losses in auctions of failed banks. We will take a close look at regulatory impediments to blockchain, stablecoins, and new payment systems. And we will consider reforms to unleash the awesome power of the American capital markets. Americans deserve a financial services industry that works for all Americans, including and especially Main Street. Under President Trump's leadership, the Treasury Department and I will deliver that to you. Thank you.
Thank you, Mr. Secretary, for your comments on the future regulatory landscape and apparatus, and we're going to get to that in just a minute. First, I'm going to ask a couple of questions about news of the day, and then we'll go into the regulatory framework. So, Mr. Secretary, first just about the state of the economy. We've had about a week to digest the announcements from the President, and we've seen some of the world's response. What's your message to the bank leaders here in the room about the state of the economy and the market reaction?
Well, thank you for having me. And, I would say people in this room know more about the state of the economy than I do. That I have always been, for my investment business, we used to do what was called the micro driving the macro. So we did not have any better model for predicting non-farm payrolls, core PCE, that, because I think a lot of that is this. But what we did was we went out, we talked to banks, we talked to businesses, we constructed a mosaic from the bottom up. And I can tell you that there is a little uncertainty, but that in general, the companies that I've spoken to, the people who have come, the CEOs who have come into Treasury, tell me that the economy is very solid. We got very good jobs numbers last Friday. So, I think that we are in pretty good shape.
Thank you. Tariffs. It's been about a week since the President announced his plan. The reciprocal tariffs went into effect last night. And I know, and I've been reading and listening to you and other administration officials who've said that depending on how some other nations react, those could come down or those could go away. So if you could share a little bit on Have you been encouraged with the response from other nations to the administration? Has it been what you've been hoping for? What's that outreach from across the globe been like, and how are those negotiations going?
Well, Rob, I will tell you that on Wednesday, after the president gave his address in the Rose Garden, as I was doing media, I was out telling other countries, don't retaliate. And I think what a lot of people are missing here is that the levels that were put out last Wednesday are a ceiling. So if you don't retaliate, that is the ceiling. So we've been overwhelmed with the response to come to D.C. and negotiate. President Trump on Monday had a very good call with the Japanese Prime Minister. He had a very good call with the President of Korea yesterday. We're seeing a delegation from Vietnam. So I think we have about 70 negotiations lined up. I'm not planning on going anywhere for Easter. And I believe that I had obviously been providing advice on the tariffs, working more on the tax bill that we'll talk about. And now I'm going to take a lead negotiating role in a lot of the tariffs, starting with the Japanese delegation. But in terms of escalation, unfortunately, the biggest offender in the global trading system is China. And they're the only country who's escalated. And I can tell the rest of the world that I'm not sure whether it was the Prime Minister or the Economic Minister in Spain made some comments this morning, oh, well, maybe we should align ourselves more with China. That would be cutting your own throat, because I can tell you that these Chinese exports that the U.S. tariff wall is going to keep out, that China, for all of you who can remember that Disney movie of the brooms carrying the buckets of water, that is the Chinese business model. It never stops. They just keep producing and producing and dumping, and it's going somewhere. And I think, Rob, at the end of the day, that we can probably reach a deal with our allies, with the other countries that have been long-term. They've been good military allies, not perfect economic allies, and then we can approach China as a group.
One other question on news of the day, and then we'll go into regulation and some other Treasury agenda items. So you're the point person for the President of the United States on the spending bill, the budget, and the tax bill. How are those negotiations going right now? Is this something that will get done for the August recess? How's that going to play out?
So it's going better than expected, but I may live to regret that remark. I understand you're seeing Congressman Arrington today. I would urge him for tell him that you want certainty on taxes for yourselves, for your customers. And look, the reason I came out from behind my desk, I'm not sure what a budget hawk looks like, but I see one when I look in the mirror. And one of the reasons I came out from behind my desk was this incredible fiscal prolificacy and irresponsibility that the last administration did, 6.7% deficit to GDP. We have never seen when we weren't at war or in a recession, and they just spent. So what we're trying to do is bring down government spending, right-size the federal workforce, and then on the other side, as I just described, through safe, smart, and sound financial deregulation, make it possible for you all to re-leverage the private sector. We want to deleverage the government sector, re-leverage the private sector, but we can't do it all at once. And I tell these congressmen, I tell the senators, look, our fiscal situation is a 350-pound, 2-pack-a-day smoker on the ICU table, and he or she is not going to get off that table and run the Ironman. And we're going to get on a treadmill. We are going to bring the deficit to GDP hopefully down by 1% every year and get it back toward the long-term target of 3.5%. So and look, I understand why some of these congressmen, some of these senators, they are rabid and like, we got to do it now, but we can't do it all at once, or that will cause a recession. What will keep us from having a recession is making sure that the tax bill doesn't expire, adding back 100% depreciation, and then adding some of President Trump's agenda, no tax on tips, no tax on Social Security, no tax on overtime, and making, when I bought my first car, I'm 62, when I bought my first car, auto loans were tax deductible. So we're going to do that again for American-made cars.
Thank you, Mr. Secretary. Now let's go segue to regulation. I was taking notes and reading the full speech behind the stage, and a couple of highlights stood out. And I have a question for you. The important role community banks, the important and unique role community banks play in our economy, tailoring regulation, change in the culture of supervision. You mentioned deposit insurance modernization in the written remarks, resolutions to AML framework, bank resolution, regulatory capital, your concerns with Basel, your concerns around, non-bank financial intermediation and activity. I mean, this, Mr. Secretary, is an ambitious, warranted, and most welcome set of reforms. So thank you. My question for you is, how are you going to go about doing all of that? That's a big, big list, and you have an incredibly important role. So what's the strategy to try to get all this done?
Yes, so Rob, I was fortunate that President Trump entrusted me on behalf of him with choosing the personnel for these spots. Jonathan McKernan's here today. He's going to lead the CFPB. Jonathan Gould, I think, is about to be confirmed as head of the OCC. Travis Hill is acting at FDIC. Brian Quinez at CFTC. Mickey Bowman moving up. Everyone in this room's friend, Michael Barr, moving down. Mickey Bowman moving up. So I do believe policy is personnel, personnel is policy. So I'm just the conductor, and I got a great orchestra, and we're going to make great music.
Well, we're going to be partners with you on making that music. Thank you, Mr. Secretary. We have about 2 minutes left with the Treasury Secretary, so two other really quick ones. Fighting fraud, which is a huge priority for us at the ABA. We welcomed your announcement quite recently of moving away from paper into digital forms of payments out of the Treasury. We think that is fantastic. Let's talk a little bit about the transition and how we make that work together.
Right. So, unfortunately, mail fraud has actually picked up. And I don't have to tell people and hear about check washing and all of that. So we are trying, for government checks, we are trying to make that more paperless because it's more secure and more efficient. So we'll see what happens. I think, unfortunately, just like auto accidents, we can put in seat belts, we can put in all the warning systems. There's still going to be auto accidents, but I think we can start pushing that down.
We agree, and we have all these public awareness campaigns that we're going to continue to bring to bear. Banks never ask that. Practice safe checks, safe banking for seniors. All of these, which will complement the effort that Treasury has put forward, which we think is great. And in our last minute, Mr. Secretary, I know for you, we've talked about this before, a priority for you is financial literacy. So I want to give you the last minute to talk about why that's a priority for you and where you aim to steer the Treasury Department going forward.
Sure, and Rob, look, I may seem very exciting, but I actually began my career as a banks analyst and insurance analyst, and if you think being a banks analyst it ruins your eyesight, being an insurance analyst is worse. So I used to read Camel reports. I've read Kansas statutory life insurance reports, and look, I've seen the way to grow the American dream. Most people that just want to know the way forward. And what we saw with Occupy Wall Street was a disenchantment with the system. And I believe that we have to bring more people into the system. I lived in Miami for a while, and as part of our church, we went and helped the people in the community, underserved communities, prepare their tax returns. When you show somebody they're getting a refund, that they didn't know they were going to getting. It's very, very exciting. So we've got a big cohort in the U.S. who just they want to know, like, how does money work? How does household balance sheet work? And I think the community banks, along with Treasury, can play a big role in that. And it stops financial fraud. I will confess to everyone in this room, my deep, dark secret is I am from South Carolina, and like many people there, I have a Dr. Pepper for breakfast, which puts me at the Circle K on Meeting Street at about between 7 and 6, because I don't do it at home. It's kind of like getting sent outside. I don't want my kids to see it, so but it puts me at the Circle K on Meeting Street in Charleston, South Carolina, 7:30 in the morning. There are a bunch of young men in there, primarily African American. The construction workers go into work, and they'll come up, Mr. When I win the lottery, will you manage my money for me? The best thing you can do is not play the lottery. But they don't understand how to put the money away, how to create wealth, how to put it in the stock market. And they want to learn, and I think that that's going to be a big part of the American dream. I think that during the recovery or the rescue phase of COVID, it was very important to get those checks out. We probably sent a little too much out during the recovery phase. But like those households have gone through a lot of that, and I think with proper financial literacy, they could have improved their savings. That College of Charleston, my hometown, has a great program for students who first ones in their family to go to college or are on full financial aid. These kids show up. American Express is in the freshman quad, signing them up to a credit card, and within 3 semesters, they're over their head in debt, and they got to drop out. So, like the American dream, that I think financial literacy or financial security is the American dream, and everyone in this room can do to help. Treasury, if you have ideas, bring them to Treasury. This is Financial Literacy Month, and we're going to be working with a lot of organizations. We're going to do it every April. We're going to have 3 more of these, so I'd love to be a part of that with everybody in this room.
Well, that's great. Mr. Secretary, thank you for joining us today. Thank you for your leadership on behalf of the nation. Please join me in thanking Treasury Secretary Scott Bessent.